I want to talk about the impact of time on investments, and particularly I want to use the example of a stock market index, and one for which a lot of data is available, like the S&P 500 index. Now the reality is that when we look at the stock market over shorter periods of time, like 1 year, like on an annual basis, the returns go up and down, up and down, up and down in almost what seems like a random pattern. And the reality is that it's very, very difficult to time stock markets precisely. There have been many studies done on this, and the reality is on a short-term basis it's quite difficult to time the stock market because it's quite difficult to predict events that will take place. Some of these events are more predictable than others. You know, to some extent we can predict largely without any major disruptions what will happen to a company's earnings. But you know, when major environmental events take place, or major political events take place, or major changes take place, these are very, very, very difficult to predict. In fact, impossible to predict. So the stock market on a short-term basis can really suffer from those events or really benefit from those events. So the bottom line is that the stock market moves up on an annual basis, but to know exactly when it's going to go up or when it's going to go down is actually quite difficult. Now, it's quite difficult, and arguably whether we agree that it's difficult or not is a subject for discussion. Many researchers will actually argue that it's impossible to predict on a short-term basis. But whether it's difficult to predict or not is actually largely irrelevant. What's really important is that it's difficult to predict, and it's much more difficult. It's actually much more difficult to predict than what the stock market does over any longer period of time. Because when we look at the stock market performance over a 5-year basis, 10-year basis, 20-year basis, or 30-year basis, then the returns start to normalize out. And why is that the case? Well, because what is happening is the companies are generating value over longer periods of time. It's just that you don't know exactly what's going to happen in the short term. But the reality is good companies do rise in value. Workers are employed at these companies and they're creating value. People are putting ideas and sweat into these businesses, and that's generating value. And if that wasn't the case, it would be a major breakdown of our financial system. So that's a reflection. The stock market rise over longer periods of time is a reflection of the fact that value can be added through effort and ideas. So that we can be pretty sure about, and that I think is something that many of us and most of us probably can agree will continue to be the case. Hard work, ideas, sweat, and so forth will continue to generate value and does make a difference. But let's look at the short-term performance of the stock market on a 1-year basis. The chart looks like this. And this is taking data from 1939 to the end of 2006, annual data, S&P 500 to the end of the year. What would happen if we invested over 3-year periods? So for example, if we had invested at the beginning of 1939, we would have been down by 0.5% in the first year, down 9.7 in the second year, and down 11.2 in the third year. And if we, in that 3-year period, we would have lost 20.2% of our money. And we can look at what happens over any 3-year period and figure out what that means for the annual return of any given year in that 3-year period. In other words, what is the average return for 1 year within that 3-year period? And when we do that, we end up finding out that the returns start to normalize out. And we can look at the calculation, and it looks as follows. And we can see in the table that the 3-year returns start to, when we annualize them, they start to look at much more flat. And we can see this in a chart as follows. So what we see here are the returns that we would receive on an annual basis for money left in the stock market for 3-year periods. We can do the same thing if we leave our money in the stock market in the S&P 500 if we had left it in for 5-year periods and see what the annual return would be. And we can leave our money in, and we can see what would happen if we left our money in for 10-year periods and see what the annual return would be. So this is again the annual return, and we can see that it starts to normalize out and become much, much more predictable. So in other words, the average return that we would receive per year becomes much more predictable when we leave the money in the market for a longer period of time. Let's 20-year period. And let's finally look at what happens for a 30-year period. In the case of the 30-year period, including dividends, we can see that the return really starts to, the annual returns really start to get bunched up in the range of 10 to 15%. And so what's the conclusion? The conclusion is, with a volatile asset like equities, we can predict the returns, get a much more predictable return on an annual basis even, if we leave the money in place for a longer period of time. That means a number of things. The first thing it means is that if we are putting money into this, if we have a short-term horizon, then something as volatile as an equity market index or equity market investments may not be ideal, because if we're forced to sell after 1 year and a major economic event takes place that we were unable to predict, takes place after 1 year or within that 1 year period, and we have to sell because we need the money again, then we may be selling at a low and we may run into a financial problem. And the second thing it means is that when we think about our savings for the long term, and we think about saving with a horizon of 20, 10, 15, 20, 30 years, then an equity investment starts to make a lot more sense. And looking at these returns, these historical returns, which are not necessarily predictors of the future, but looking at these historical returns, we can see that the returns are A, attractive, and B, predictable if we leave the money in place for a longer period of time. And this has been the case for the data that's been compiled here, which is since the beginning of 1939 or the end of 1938. And stock markets have tended to rise over time on the assumption that hard work, effort, and the economic climate will exist for people to add value in companies through ideas and hard work.